My name is Peter Stasiuk, and I'm here to help viewers of my channel achieve financial independence. Who am I? I am a senior commercial realtor working for a world-class commercial brokerage firm, and I specialize in the buying and selling of investment-grade, income-producing commercial properties for high net worth individuals and institutional firms. Over the course of my career, I've had a ringside seat to watching how real estate fortunes are made and how generational wealth is created. I'm now taking my knowledge, expertise, and experience and sharing my vast insider knowledge with subscribers to this channel. In my last video, I mentioned that the golden path to financial freedom lay in the accumulation of income-producing financial assets. So now you need to compare the returns that you can get from the different asset classes out there so that you can judge for yourself what asset class is the best income-producing investment vehicle for yourself. But before we get to that, we need to make sure that we're comparing apples to apples. One of my pet peeves is that the mass media out there misrepresents the true returns that one can get from real estate investing. The mass media are truly missing out on how good real estate investing actually is. And consequently, the majority of people all too readily accept the advice of others. Namely, that since the mass media reported returns on real estate is typically in the 5 to 7% range per year, and since you can get a similar or better yield from other investments, why bother with property at all? Few people ever sit down and measure the true returns that one can get from real estate investing. The mass media will say, for example, that the return on real estate last year was 6%. But that's only one measure of the 4 areas of return in income-producing real estate investing. In other words, they're only looking at the tip of the real estate investing iceberg. The mass media does not conduct a deep dive and delve into the actual returns that real estate investors actually achieve. So let me help clarify the actual returns that one could get in income-producing real estate investing. There are 4 basic areas of return that one could get when investing in income-producing real estate. The first is from the application of leverage. The second is from the cash flow that the property generates. The third is from the appreciation in the value of the property. And the fourth is from the principal paydown of the mortgage that's on the property. Let's look briefly at each of these areas of return. Leverage. When you buy a government bond, you usually have to put up the full face value in cash. And the same usually goes for investments made in the stock market. However, when it comes to buying a property, while you may choose to pay the full amount in cash, people rarely do. That's because real estate is very unique in the investing world. People can and usually get a mortgage for 20%, 50%, 70% of the value for the property. In other words, it is not comparing apples to apples to compare the performance of a $100,000 investment in CDs, money market funds, or the stock market with a $100,000 property. An apples to apples comparison would only be the case if someone had bought the entire property for cash, and no one that I know of does that. That's because the banks out there are very willing to loan money for investment-grade, income-producing commercial properties. Consider this. When people go about purchasing real estate, most people only put up 20 to 25% of the purchase price in cash. The balance, and the majority of the purchase price, is borrowed from a bank or other financial institution in the form of a mortgage. For argument's sake, let's take a hypothetical example of a $1 million industrial warehouse. Let's assume there is a down payment of $200,000 as part of the deal and a mortgage for the balance of the purchase price, so that would equate to a mortgage of $800,000. Imagine that. A bank paying for the majority of the purchase price for a property that you own and a mortgage that your tenants will pay off for you. That's the magic of investing in real estate. What we are really interested in when calculating the return on the real estate investment is not the overall return on the entire $1 million purchase price, but the return on the $200,000 cash that was invested. Remember, it is absolutely imperative that we know the exact amount of cash invested so that you can accurately gauge the return on your investment and compare apples to apples when looking at different income-producing financial asset classes. Cash flow. All income-producing real estate investments generate cash, and that is from the rents that the tenant or tenants pay the landlord every month. The landlord then takes these rents and applies them to the bills for the property for the month. So realty taxes, insurance, repair and maintenance, electricity, water, etc. The money left over at the end of paying the bills is referred to as the net operating income for the property. And the good news is that the rents are always increasing over time. Remember that. Typically, an investment property is sold at what's called a cap rate. A cap rate is short for capitalization rate. The simplest explanation for this is the yield that one would get on this property if the property was bought for all cash. So if a property is being sold at an 8 cap, then anyone paying for this property with all cash would get an 8% return on their cash invested after having paid off all of the operating expenses for this property. Appreciation. Appreciation in real estate is the growth in value of a property over time. So typically the reported return for real estate over the long term is anywhere from 5 to 10% per year. As an aside, a general rule of thumb is that real estate should double every 10 years or so. And if one uses the investing rule of 72, that would imply a return of about 7.2% per year. The return that one gets from appreciation can be substantial. Let's consider our $1 million industrial warehouse example. Let's say that it will increase in value this year by 6%. At a $1 million valuation, a 6% increase would equate to an increase in value for the property of $60,000. But remember, we only put up $200,000 in cash. So our actual return on appreciation is that $60,000 divided by our $200,000 cash investment, or a return of 30%. And that's in 1 year. So while the mass media reports that commercial real estate went up by 6%, for example, the actual return made by savvy commercial real estate investors is much, much higher. And this is just one area of return for investors. Let's keep going. Principal pay down of mortgage. You know, it's really nice when someone else pays your bills. And real estate is the only investment I know of where your tenants every month give you the money you need to pay your mortgage. So you use a mortgage loan to fund the majority of the purchase price for the property. The tenants then give you the cash you need to pay that monthly debt. And If you give the tenants enough time, they will completely pay off your mortgage so that you end up with a free and clear property. How cool is that? The principal pay down of a mortgage is also referred to as the amortization of a mortgage. It's basically the liquidation or the elimination of the mortgage debt through monthly payments over time. It is a blend of interest and principal, with more interest being paid at the beginning of the term and then more principal being paid towards the end of the term. So now that we know the 4 areas of return for an income-producing investment property, let's apply our knowledge and look at a hypothetical investment example. Okay, so here's our example for an income-producing property investment. Our assumptions: this is an apartment building with a $1 million purchase price. The financing, let's assume a $200,000 cash down payment. So we have an $800,000 mortgage. Again, for this hypothetical example, we're assuming an 8% cap rate. And then the mortgage details, we're assuming a 6% interest rate and a 25-year amortization period. So this would result in a $5,154 monthly mortgage payment, which includes your principal and interest, which results in a yearly mortgage payment of $61,852.92. So let's look at our 4 areas of return. First, we need to know the cash that we have invested in the property. In this case, $200,000 or 20% of the purchase price. The cash flow per year, again, an 8 cap on a $1 million value would imply an $80,000 net operating income. If we subtract from that the mortgage payments of $61,853, that leaves us with a net cash flow for the year of $18,147. Again, we're assuming an appreciation of 6% on the purchase price. So that would be $60,000. And the mortgage pay down per year, we've just taken an average. Now I know there's more interest paid in the beginning and more principal paid at the end of the term, but we're just going to average it out just for simplicity's sake. Take here. And so the $800,000 mortgage that we have, we're going to divide that by 25 years. So on average, it's about a $32,000 pay down on the mortgage. So let's look at the overall return on investment. Again, we have $200,000 invested. So an $18,147 net cash flow is 9.07% return for the year. Appreciation of $60,000 is a 30% annual return on our investment. And then the mortgage pay down, an average of $32,000 would be a 16% annual return. So altogether, we have 55.07%, a total annual return on this hypothetical example. And that shows you just how lucrative real estate investing is. And that just shows you the potential that you can have with investing in real estate. Okay, a quick programming note here before I get inundated with negative comments. This is just a hypothetical example. It's meant solely for you to grasp the concepts of the different areas of return that one gets when it comes to investing in income-producing real estate. It's meant to open your eyes to the possibilities involved. Every investment is different. Interest rates fluctuate up and down. The down payment required by financial institutions vary over time and by property asset class. Cap rates go up and down, and appreciation rates vary, as they do for all financial assets. So this hypothetical example is meant to point out the different areas of return that real estate provides and to open your eyes to the possibilities involved and to show you that the reported returns that the mass media provides for real estate is misleading. So, the foundational understanding of how returns are made in real estate is now in place. You now know that every income producing property has the potential to provide you with as many as 4 different returns: cash flow, leverage, appreciation, principal pay down of mortgage. Leverage is unique to real estate, and it amplifies the return one gets because you put up far less cash than the price of the property. Cash flow is the money you have after paying all the bills and the mortgage payments. Appreciation is the growth of the property over time. And the principal pay down of mortgage is the paying off of the mortgage over time from the money your tenants give you. You're now ready to start getting serious about investing in income producing properties and grabbing that first foothold onto that golden path to financial freedom.